50 million barrels of oil, loaded, sailing, ready for delivery, and then nothing. China simply said no. No press conference, no threat, no explanation, just silence. And that silence? It's quietly rewriting the rules of global power in ways most people will never see coming until it's already too late. Let's start at the beginning, because the full picture here is something most mainstream headlines completely missed. The United States, operating through its long-standing sanctions framework against Venezuela, repositioned roughly 50 million barrels of Venezuelan crude oil. The plan was clean on paper: take control of how that oil moves, price it under American oversight, route it to approved buyers, and send a clear message to the world: Washington still controls Venezuelan energy exports. Simple, controlled, effective. Except China didn't cooperate. Beijing issued a full suspension of Venezuelan crude imports, specifically any crude operating under that U.S.-supervised structure. Ships already mid-voyage were halted. Payments waiting to clear were frozen. Contracts still being negotiated were killed on the spot. And then China sent a message that echoed through every trading floor on Earth. If your vessel is carrying Venezuelan oil tied to this American framework, it will not dock at a Chinese port. No exceptions. No negotiations. No appeals. Now, your first reaction might be, okay, America and China are clashing over Venezuelan oil again. That happens. Big powers compete. What's actually new here? Here's what's new. China is the world's single largest importer of crude oil. When the world's biggest buyer refuses to participate in your pricing system, not because it can't afford the oil, but because it refuses to recognize your authority over it, that is not a trade dispute. That is a structural fracture in the global energy order. And fractures, as history has shown us repeatedly, do not heal quietly. Before we go any further, we need to talk about Venezuela. Because when most people hear the name, they picture economic collapse, political chaos, empty supermarket shelves. And yes, all of that is real. But there is another side to Venezuela that almost nobody ever brings up in polite conversation. Venezuela holds approximately 300 billion barrels of proven oil reserves. Take a moment with that number. 300 billion barrels. That is more than Saudi Arabia, more than Iran, more than Iraq. By raw reserve count, Venezuela is the most oil-rich nation on the face of this planet. The catch? Most of it is heavy crude, thick, dense, sulfurous, stubborn. It doesn't flow like the light, sweet crude you see in textbook diagrams. It requires specialized refineries with the right equipment, the right chemistry, the right setup to process it into anything useful. And for decades, the refineries best equipped to handle exactly that kind of crude. They sat right along the U.S. Gulf Coast. Geography made Venezuela and America natural partners. The oil fit the machines. The machines were in America. Money flowed south. Crude flowed north. It was a relationship built on geology as much as politics. It worked. Then came the sanctions, and everything changed. Starting around 2017, the United States began methodically tightening the financial screws on PDVSA, Venezuela's state oil company. Dollar-based settlement channels were restricted. American firms were barred from routine transactions with Venezuelan entities. The economic pressure was deliberate, calculated, escalating. By 2019, Washington went further. The Trump administration recognized Juan Guaidó as Venezuela's legitimate president, and in a move with enormous real-world consequences, transferred operational control of Citgo Petroleum Corporation to the Guaidó faction. If you don't know what Citgo is, it matters. Citgo operates refineries across the southern United States. It runs hundreds of fuel retail stations. For Venezuela, Citgo was the golden goose, its most reliable source of hard currency, its lifeline to the global financial system. In one political stroke, that lifeline was cut. From that point forward, Venezuelan crude entered what analysts quietly call survival trade. Oil that still moves, but moves awkwardly, at steep discounts, through intermediaries, via financial workarounds that add cost and friction at every step. Venezuela could still pump oil. It just couldn't get paid cleanly for it. And here is the critical part that most coverage skips entirely. Washington became the gatekeeper, not through military occupation, not through naval blockades, but through finance, through settlement systems, through compliance architecture that every bank, every insurer, every trading house on earth had to navigate before touching a single Venezuelan barrel. The United States had built a valve, and it controlled the pressure. Meanwhile, on the other side of the world, China had been quietly building its own relationship with Caracas. Over the years, Beijing extended roughly $60 billion in loans to Venezuela, a massive bet on a country that Western investors had long since written off as a lost cause. The repayment structure was elegant in its simplicity. Venezuela didn't pay China back in cash. It paid in oil, subsidized, below-market crude that arrived at Chinese ports on a predictable schedule. For Venezuela, it was oxygen. For China, it was discounted energy with geopolitical leverage built right in. That arrangement worked, until Washington restructured the terms. Under the new U.S. supervised framework, Venezuelan crude that had been trading at deeply discounted prices was being repositioned upward. Some market estimates suggest a move from around $31 per barrel toward $45 per barrel under compliance structures tied to American oversight. But here's the thing. The dollar figure is almost beside the point. What Beijing was actually looking at was this. If we accept these barrels under this structure, we are accepting American authority over our energy supply chain. Full stop. And for China, a country that has spent 2 decades systematically reducing its exposure to U.S. financial leverage, that was never going to be acceptable. Accepting the structure once means the structure becomes the norm. Pricing authority today, volume restrictions tomorrow, settlement currency conditions next. China had watched this playbook before. It wasn't going to audition for a supporting role in it, so Beijing closed the door. Here is where this story stops being abstract. Here is where it gets personal. When China pulls 50 million barrels of Venezuelan heavy crude off the global market, even temporarily, something very specific happens to the world's energy balance. Heavy crude is not a substitute for light crude. It is a fundamentally different product, processed by different equipment, refined into different outputs. You cannot simply swap one for the other like changing a setting on a machine. When heavy crude supply tightens, the refineries that depend on it, along the U.S. Gulf Coast, in parts of India, across certain Asian facilities, have to scramble for alternatives. They look to Mexican Maya crude, to Canadian Western Select, to other heavy grades with similar chemical profiles. But those alternatives are not in unlimited supply either. When buyers compete for scarce heavy crude, prices rise. The gap between heavy grades and the global benchmark, what traders call the Brent-Maya spread, widens. And when that spread widens sharply, it is a flashing yellow light. Heavy crude is tight, and complex refiners are paying a premium for it. That premium does not stay on a trading screen. It travels. It travels first to diesel. And diesel matters more than most people realize. Trucks run on diesel. Tractors run on diesel. Cargo ships run on diesel. When refinery margins on diesel, called crack spreads, widen, it means diesel is expensive to produce. That cost moves through supply chains fast. Within weeks, not months, freight costs adjust. When freight costs adjust, the price of everything moved by road or sea adjusts with it. That is food. That is medicine. That is the shirt on your back and the phone in your hand. And the chain does not stop there. Let's talk about tankers, because the shipping market is where this story becomes both fascinating and alarming. When China refuses Venezuelan crude, those cargoes don't simply disappear. They keep moving. But now they need new destinations. Ships that might have sailed from Venezuela to Chinese ports in a relatively efficient arc are suddenly traveling much farther to find willing buyers. Longer voyages mean ships are at sea longer. Ships at sea longer means fewer available vessels in port. Fewer available vessels means charter rates rise. Industry estimates suggest a 15 to 20% spike in heavy crude tanker rates can meaningfully increase the delivered cost per barrel for receiving nations. Multiply that across millions of barrels, and the financial impact on importing countries is significant and sustained. Now layer in insurance. When a tanker carries Venezuelan crude, already a sanction-sensitive cargo, underwriters have to price the jurisdictional risk. If China has explicitly closed its ports to those vessels, insurers must model the scenario where a fully loaded ship is turned away mid-voyage. That scenario is expensive to price. Premiums rise. Higher premiums make borderline trades economically unviable. Fewer trades mean less price competition. Less competition means more volatility. And in commodity markets, volatility is contagious. It spreads from oil to freight, from freight to food, from food to inflation indices that central banks watch nervously before deciding whether to raise or lower interest rates. Now here is the layer that, honestly, most news coverage completely misses. It's the part that may be the most consequential of everything we've discussed so far. For decades, global oil markets have operated almost entirely in US dollars. You want to buy oil? You settle in dollars. Those dollars get recycled into US Treasury bonds, into dollar-denominated financial assets, and back through the system that funds American deficit spending. Economists call this petrodollar recycling. And, well, it is one of the quiet structural pillars holding up American financial dominance. When energy settlement stays in dollars, demand for dollars stays elevated. And when demand for dollars stays elevated, the United States can issue debt cheaply. When debt is cheap, interest rates stay manageable. When rates stay manageable, mortgages are affordable, businesses can borrow, and the broader economy keeps moving. Now just ask yourself, what happens if that starts to shift? China's refusal to participate in U.S.-supervised Venezuelan oil transactions is not only about Venezuelan oil. It's actually a test of whether the dollar remains the mandatory language of global energy trade. Every cargo that settles outside dollar channels, even marginally, applies pressure to that system. Nobody expects an overnight collapse. That is not how systemic shifts work. But consider this. If just 2 or 3% of incremental energy settlement begins moving toward alternative mechanisms, yuan-denominated trades, bilateral barter arrangements, currency swap agreements, over a sustained period, the marginal demand for U.S. Treasury bonds softens. Treasury markets are priced on marginal buyers. In a period when the U.S. government is running substantial deficits and issuing enormous volumes of new debt, softening marginal demand can translate directly into higher yields. And higher yields have a name most people recognize: the 10-year Treasury rate, the benchmark for the American economy. Analysts suggest it could drift 30 to 40 basis points higher under these compounding pressures. That sounds like a minor technical detail. It is not. A 40 basis point rise in the 10-year yield affects mortgage rates. Mortgage rates affect housing affordability. Housing affordability affects consumer spending. And consumer spending drives roughly 70% of the American economy. We started with tankers sitting off the Venezuelan coast. We just arrived at your ability to afford a home. That is the chain. And it is real. China's resistance isn't operating in a vacuum. There is a historical parallel that tells us a great deal about how this kind of standoff actually plays out. Iran. In 2012, the United States removed Iranian banks from the SWIFT international settlement system and sanctioned the Iranian central bank directly. The effect was devastating and swift. Iranian oil exports collapsed. The rial cratered. Inflation surged. Washington had proven, beyond any doubt, that financial architecture could be weaponized more effectively than military hardware. In 2018, after the U.S. withdrew from the Iran nuclear agreement, sanctions returned at even greater intensity. At one point, Iranian oil exports reportedly fell to near 300,000 barrels per day, a fraction of what they had been at peak. But here's what happened next, the part that sanctions hawks rarely discuss. Iran didn't surrender. Iran adapted. Ships began disabling their AIS tracking transponders, the maritime equivalent of switching off GPS. Ship-to-ship cargo transfers in international waters obscured the origin of cargoes. Oil was blended with crude from other origins to mask its chemical fingerprint. A shadow fleet emerged. Tankers operating outside normal insurance and regulatory frameworks, willing to carry sanctioned oil for a premium. Enforcement slowed the movement. It did not eliminate the oil. Venezuela is walking the same path. And China, watching all of this unfold, understands something Washington may be dangerously underestimating. Prolonged financial pressure on a major supplier does not eliminate supply. It creates alternative infrastructure. It builds parallel systems. And once those systems exist, they do not disappear when political winds shift. There is another player in this story that, honestly, deserves careful attention. India. Washington's apparent strategy involves redirecting Venezuelan crude toward Indian refiners, sweetened with tariff flexibility designed to make those barrels commercially attractive. And India has real capacity here. Indian refineries can process heavy crude. India has the demand, and India has historically shown a willingness to buy discounted oil from sanctioned producers, as it demonstrated clearly during the debate over Russian oil price caps following the 2022 Ukraine invasion. But here is India's problem. Every barrel of Venezuelan crude it accepts under American supervised terms comes with a compliance tail, and that tail has teeth. Indian refiners, banks, and insurers need absolute certainty that their dollar-clearing channels through U.S. correspondent banks remain intact. Because if secondary sanctions are triggered, the consequences are severe. Iranian crude buyers discovered this the hard way after 2018. Frozen assets, blocked transactions, and reputational damage that lingered for years. Any ambiguity in Washington's assurances raises hedging costs for Indian refiners. Higher hedging costs compress margins. Compressed margins make the discounted Venezuelan crude far less attractive than it looks on paper. India is attempting, as it frequently does, to walk a line between Washington's requirements and its own national energy interests. That is an extraordinarily difficult balance to maintain when the world's two largest economies are pulling in opposite directions with increasing force. One more piece of this geopolitical puzzle, and honestly, it's a significant one: Russia. Moscow has been publicly critical of U.S. restrictions affecting Russian involvement in Venezuelan energy infrastructure. Russia has its own entrenched interests in Venezuelan oil development dating back years. And since 2022, Russia has become perhaps the most prominent real-world demonstration that large-scale energy trade can be restructured outside dollar-denominated channels. The conflict in Ukraine didn't just redraw European energy maps. It dramatically accelerated the search, across multiple emerging economies, for payment systems that do not route through New York clearing banks. If Venezuelan export constraints tighten further, if China holds firm, if India hesitates, Russia and China have every incentive to help Venezuela build out the alternative infrastructure needed to move oil without American oversight. That means shadow fleet expansion, renminbi-settled transactions, insurance arranged outside Lloyd's of London. The ingredients for a parallel energy trading architecture are not hypothetical. They are already being assembled, piece by piece, cargo by cargo, deal by deal. So, where does all of this lead? Let's be precise here, because this is a story that will not unfold in dramatic headlines. It will play out quietly, in data, in spreads, in indices that most people never look at. Here are the specific signals that will tell you whether this standoff has crossed from geopolitical posturing into genuine systemic stress. Watch the Brent-Maya spread. If Venezuelan heavy crude stays out of Asian circulation, alternative heavy grades tighten. If that price gap widens sharply and holds, heavy supply scarcity is real, and refiners are paying the price. Watch diesel crack spreads. Diesel is the fuel of the real economy. Sustained elevation in those margins means freight costs are rising, and that pressure travels through supply chains to food prices, manufactured goods, and consumer inflation. Watch the Baltic Dirty Tanker Index, which tracks crude oil freight rates globally. If heavy crude tanker rates spike and remain elevated, the cost of delivered energy for importing nations is climbing. Watch insurance premiums on Venezuelan origin voyages. Rising premiums mean marginal trades become uneconomic, market liquidity shrinks, and volatility increases. And watch the 10-year Treasury yield, not in isolation, but in combination with these other signals. If yields drift higher while diesel cracks stay elevated and heavy crude differentials widen simultaneously, the transmission from commodity markets to financial markets is happening in real time. None of these signals will be accompanied by press conferences. No world leader will stand at a podium and announce that the global energy order is under stress. It will show up in spreads and rates and indices, in the quiet, unsentimental language of markets, which always price power shifts before politicians are ready to acknowledge them. Let's zoom out one final time and look at what this story is really about. At its core, this is a question that has defined global order for the better part of a century. Who holds the authority to set the rules of trade for the world's most essential commodity? For most of the post-war era, the answer has been the United States, through dollar settlement, through financial infrastructure, through the implicit but very real threat of exclusion from Western capital markets for anyone who steps out of line. That answer is now being challenged, not with armies, not with declarations of war, with cargo decisions, with port closure notices, with compliance desk memos, with the quiet redirection of tankers toward alternative routes and alternative buyers. China is not trying to destroy American power overnight. It's doing something more patient and arguably more effective. It's systematically reducing its exposure to American leverage, one structural decision at a time. The Venezuelan oil refusal is one chapter in a story that has been building for years, and has many chapters still to come. Here is the uncomfortable truth that this entire story leaves us with. The 300 billion barrels sitting beneath Venezuelan soil are not going anywhere. They cannot be sanctioned out of existence. They can only be delayed, rerouted, or repriced. Washington knows this. Beijing knows this. Every trading house, every sovereign wealth fund, every refinery manager with skin in this game knows this. The question is not whether Venezuelan oil flows. It will flow. The question, the only question that truly matters, is under whose rules. That contest is quiet. It is technical. It is financial. And it is deeply, profoundly consequential. Most people have no idea it is happening. The tankers sitting on that water aren't just carrying crude oil. They are carrying the weight of a world order being renegotiated, barrel by barrel, cargo by cargo, in shipping lanes far from the cameras, far from the headlines, and far from the conversations most of us are having. But it is shaping your future, whether you notice it or not. If this video changed the way you see the world, if you realize today that global power isn't decided in parliaments or press briefings, but in shipping lanes, compliance desks, and the quiet hum of commodity markets, then you already understand why this channel exists. At Threaded News, we don't chase the noise. We pull the thread. We find the story underneath the story, the one that actually explains why your fuel costs more, why your mortgage rate moved, why a decision made in Beijing or Washington can reach into your life in ways nobody warned you about. If that's the kind of journalism you've been looking for, hit subscribe. Share this with someone who thinks they know how the world works. And leave a comment below. What surprised you most in this video? Because the news isn't just what happened. It's why it happened, how it connects, and what it means for you. This is Threaded News. Stay curious, stay informed, stay ahead.